If you've been navigating the US stock market for a while now, then the scars of 2022 are likely still fresh. That was the year the Nasdaq plummeted 33%, S&P 500 declined by 19%, and Dow Jones dropped 9%. Now, here we are in April 2026, and the headlines feel hauntingly familiar. We have escalating geopolitical conflicts, persistent inflationary shadows, and a Fed Reserve agonizing over whether to pivot or hike. For many retail investors, the panic is setting in. Is history about to repeat itself? Is 2026 simply 2022 2.0, destined to wipe out 3 years of gains in a single liquidation event? While the surface-level symptoms look identical, the underlying market logic has done a 180. Today, we're stripping back the noise to determine if we're facing a bubble burst or a structural slow leak. My name is Phoebe, and you're watching TradingKey. Before we dive in, just a quick reminder that this is for research and sharing purposes and does not constitute investment advice. Understanding the logic is always more important than the trade itself. War, inflation, and the fear of heights. Why is smart money suddenly looking over its shoulder? Well, it's because the year has opened with a doomsday deja vu driven by 3 specific ghosts of the past. First, we have the return of energy extortion. In February 2022, the invasion of Ukraine shocked the global energy supply. Russia, then the world's 3rd largest oil producer, controlling 40% of Europe's natural gas, essentially shut off the tap, sending Brent crude past $130. Fast forward to February 2026, and the US-Iran conflict has flared. While Iran's direct exports are smaller than Russia's, they're holding the queen on the chessboard, the Strait of Hormuz. This 33-kilometer choke point handles 21% of global daily petroleum consumption. Any maritime blockade here creates an immediate systemic embolism in the global economy, which is why oil prices are currently undergoing a violent repricing. Second, the inflationary lag. While CPI prints for January this year came in at a seemingly mild 2.4%, seasoned investors are focusing on the second derivative. In 2022, the Fed realized inflation wasn't transitory and slammed on the brakes, hiking rates from 0 to over 4% in a year. For the whole of last year, we were drowned by the rate cut narrative. However, the current energy spike is a lagging indicator. It typically takes 2 to 3 months for oil prices to filter through to consumer bills. We are currently in the eye of the storm, and the sudden hawkish pivot from Fed members suggests the consensus on rate cuts is about to be shattered. Third, the altitude sickness of the index. Between 2020 and 2021, $5 trillion in fiscal stimulus fueled a liquidity bubble that doubled the Nasdaq 100 in less than 2 years. When the Fed tightened in 2022, that bubble popped. Today, the 2023 to 2025 rally has been driven by the AI wave. While the catalyst is different, the fear of heights remains the same. Investors are now asking if AI expectations have effectively front-run the next 5 years of earnings. Why 2026 is a different beast. Despite the similarities, the 2026 economy is fundamentally different from 2022. The first divergence is employment. 2022 was the golden era of the worker, defined by the Great Resignation and 11 million job openings. Today, the labor market has chilled significantly. The unemployment rate has climbed to 4.4%, and monthly job additions have plummeted to nearly a quarter of 2022 levels. We have shifted from employees picking bosses to employees fearing AI replacement. This anxiety acts as a natural brake on the economy that didn't exist 4 years ago. Second, we are seeing a K-shaped consumption gap. In 2022, government stimulus fueled revenge spending across all demographics. In 2026, the top 20% of earners are hitting record spending levels driven by AI stock wealth, while the bottom 80% are facing a record contraction in discretionary spend. Savings are exhausted, creating a chronic erosion of corporate margins rather than the 2022 overheating scenario. Finally, the fuel of the rally has changed. The 2021 bull market was a game of multiples expansion, like blowing air into a balloon. On the other hand, the recent AI bull market has been supported by real earnings growth. NVIDIA's profits aren't a fantasy, they're tangible cash flow. In early 2022, the S&P 500 forward PE was over 24 times. Today, it sits around 21x. This suggests the current bubble is harder than it was previously. If 2022 was a pure air bubble that popped instantly, then 2026 is a high-pressure tire that is more likely to experience a slow, agonizing leak as AI monetization struggles to keep pace with massive CapEx depreciation. How to navigate the 2026 stock market. Here's an analogy for you. Think of the 2022 market as a case of high fever. After an interest rate shot, the fever eventually broke, leading to a V-shaped recovery. But in 2026, we're dealing with a chronic disease, with labor weakening, consumer bifurcation, and diminishing AI efficiency. Unfortunately, this won't be easily fixed by a single rate cut. Now, here's our strategy breakdown for navigating the rest of the year. First, abandon the buy the dip and get rich mentality. The 1 year down, 3 years up rhythm of 2022 is likely broken. If this downturn is driven by earnings deceleration, the recovery window will be significantly wider. Second, pivot your focus entirely to earnings over valuation. In this market, earnings are the only truth. If a big tech firm shows a margin contraction in their next filing, stay away, regardless of how cheap the PE might look. If the AI suppliers like NVIDIA stop growing their bottom line, a multiple compression from 20x to 10x can happen overnight. Third, prepare for long-term low growth. The structural contradictions in the US economy today cannot be solved by monetary policy alone. We're looking at a battle of endurance, not a sprint. So, do you think the 2026 market is a case of bad flu or a chronic disease? Are you currently building a cash position or waiting for a specific signal to buy the dip? Let me know in the comments below. Thanks for joining me today. If you found this video helpful, remember to subscribe to TradingKey, give this video a like, and share it with a friend who might just benefit from learning this too. With that, I'll see you in the next one.